Well, now Chuck Rodell, who's Senior Vice President of Town Bank, is going to introduce our speaker. Come on up, Chuck.
All right, good afternoon. Thank you, President Karen. I'm excited to introduce Jason Turner. Seen Jason speak a number of times, and it's very relatable, and it's something that I think everybody's going to enjoy hearing what we've got going on with so many questions about the economy. Jason is the Chief Investment Strategist for Great Lakes Advisors, which is a Wintrust Wealth Management company. He's a member of the firm's investment committee, authors market and economic commentary. He regularly presents in the media and to professional conferences, and he works with the client managers to support institutional and private clients. As the head of the multi-asset strategy investment team, he's responsible for the portfolio strategy, for asset allocation, and for overseeing the firm's manager due diligence and selection efforts. Jason holds a BA from North Central College, his MBA from DePaul's Kellstadt Graduate School of Management, and he is one of the first global recipients of the Yale School of Management and EDHEC Institute's Certificate in Risk and Investment Management. Jason can tell us what EDHEC stands for. Prior to joining Great Lakes in 2009, Jason served in various roles for Skyline Asset Management and Ann Hewitt Investment Consulting. He's been in the industry since 2001. And again, as I said, he puts a great perspective out there for people to understand no matter what level you're at. Jason?
It is wonderful to be with you all today. I want to thank you all for the great turnout. I really enjoy doing this and being in front of groups to hopefully impart a little bit of understanding of where we have been from an economic perspective and where we may be going. First, I'll answer Chuck's question. We do have time for questions at the end, but I'll answer Chuck's question first. EDHEC, or EDHEC, is a French-based university focused in graduate education and one of the global leaders in the understanding of risk. They're in fact on par with the U.S. Ivy Leagues. So there's your definition of EDHEC, Chuck. What I wanted to start today by doing is give you a review, in effect, of where we stand at the end of 2022. That sets the stage then for where we may be going in 2023. We start any discussion of economics with a description of what are we actually talking about. And what we're talking about generally when we say economic growth is growth in GDP. And here you can see the post-pandemic quarters of GDP growth. We emerged from the pandemic with a strong consumer-driven recovery. Those dark blue bars that you see are what the Fed calls personal consumption expenditures. It's what I like to call the money you and I spend in the economy. As a consumer-driven economy, the United States rises and falls on the whims of the consumer, and that was no different in the recovery from the short pandemic recession that we experienced in 2020. That recovery was driven by a resumption in consumer spending driven largely by fiscal and monetary stimulus. And as that fiscal and monetary stimulus started to fade, the presence of the consumer driving economic growth towards the end of 2021 dissipated. And we saw actually businesses step into the gap. We all remember, or in our own businesses likely felt, the impact of constrained supply chains and some of the supply chain difficulties we've seen since the end of that short recession in 2020. And businesses, in the absence of consumer spending being incredibly high, took the opportunity to restock inventories. And that's that lighter blue bar at the very end of 2021. So we closed 2021 at a healthy number for economic growth. That number at north of 6% for an annualized growth at the end of the fourth quarter is significant. You ask what would be average economic growth here in the United States, and the general answer is going to be 3.5%. I'll tell you, in the last 3 decades, though, that number has scaled down to 2 to 2.5%. There are some good demographic reasons for that to get into at another discussion. But in terms of understanding, that is about 3 times the rate we were growing before the pandemic. So that's a significant amount of economic growth. We rolled the calendar into 2022 with an expectation that the consumer would resume their pre-pandemic level of spending, and we'd have kind of a gradual increase in economic growth. And we saw 2 quarters of negative growth. Now, the old rule of thumb would be 2 quarters of negative growth equals recession, and the NBER, the organization tasked with calling recessions officially, did not indicate that we were in recession. for two main reasons. One, the health of the consumer stayed fairly strong, and employment markets were incredibly robust. Those two instances of negative growth were actually driven by one-off instances. In the first quarter, we had an imbalance in imports and exports. Normally not a great contributor to GDP growth, but because of some of the things that occurred geopolitically with the Russian invasion of Ukraine and in terms of the shifting of global supply chains to a more open stance, we saw net exports to the negative in terms of its contribution to American GDP. In the second quarter, we saw businesses react to an environment that didn't have consumers spending at the rate they were spending, and they backed up on some of that inventory building that we saw at the end of the fourth quarter of 2021. We then put the third quarter into the books. Third quarter sees a reversal of those headwinds we saw from net exports now becoming tailwinds as trade rewrited itself, and we saw positive growth in the third quarter. So that sets the stage for the end of this month when we'll see our first estimate of fourth quarter GDP. That's likely to look not nearly as robust as the fourth quarter of the last 2 years, but a positive number nonetheless. Of course, you didn't come here to hear solely about economic growth. The question likely first on most people's minds these days is inflation. I know it's the first question I get asked. Most times people find out I'm a market strategist or an economist. What's going to happen with inflation? And what's going to happen with inflation starts with understanding of what has happened with inflation. And obviously, inflation peaked at over 9% on the headline number. There are 4 different measures of inflation up there, just so we can confuse you all a little bit more. Headline CPI is the one you see in the paper. Core CPI subtracts the volatile energy and food sectors of the economy. Those sectors move at a very rapid clip, even week to week, and we've certainly seen that at the price at the pump over the last 18 months. The other two numbers are PCE. That PCE deflator and the core PCE number are the numbers the Fed pays a little bit more attention to. Same adjustment between the headline PCE and core PCE, subtracting energy and food. But PCE is preferred by the Fed because it accounts for a couple things that CPI does not. Number one, and chief amongst them, it accounts for a concept we call substitution. In an economist world, substitution means you as a consumer may not be able to buy a good. Let's say new cars in the summer of 2021. You go to a new car lot, there are no new cars to buy. As a consumer with money to buy a car, you're not just going to say, oh, well, I'll wait a year for a new car to show up. You need transportation, so you turn around and buy a used car. That substitution means used cars now become a larger percentage of the pie, and where CPI doesn't account for that, PCE does. In either case, if we look at the averages for where we have run since 1990 through to today, inflation has averaged about 2.6%. We used to say, again, that 3% number we use for GDP is a number we use for inflation as well, that normally we see 3% on average inflation. However, it has been almost 2 decades since we've seen an inflation print at 3% before this year on a longer-term basis. This is the last cycle, so the end of the 08-09 recession through to the 2020 recession, and that rate of inflation is only about 1.6%. That shortfall, and a shortfall comes from the Fed targeting 2% for inflation. Fed targets 2% inflation. Some inflation is good. You need inflation to help you grow an economy. So some level of inflation is good. Zero inflation, bad. Negative inflation, very bad. That's deflation. Too much inflation, also bad. So it's sort of like the 3 bears. It's got to be just right. And that just right number, according to the Fed, is 2%. And they've fallen short of that for a decade before we entered this year. That's important as we put inflation into context, because over the last year, we've seen a significant amount of inflation. And we can break that into multiple different categories, whether it be goods or services, whether it be even tinier divisions in that in terms of energy as a commodity versus energy as a service. And across the board, these are numbers that are much in excess of that 2% target. We all know, we've all felt it directly in our businesses, felt it directly in our own wallets as we go to the grocery store, for example. Quick story, we all feel inflation differently. I have two kids, and both are swimmers. So their nutritional needs are out the window. I go to the store and I buy stacks of eggs. I don't just buy a dozen and they last me for 3 weeks. Kids eat a lot of scrambled eggs. Price of eggs went from $1.97 a dozen to over $5 a dozen at one point in the last 18 months. That's obviously a big impact to me because I buy a lot of eggs. There's folks out there that don't eat eggs, you didn't feel it. So you feel inflation individually. You don't feel it at these headline numbers. And that's why some of you that run more commodity-oriented businesses really felt increases in producer prices. I feel for those of you that may be in the home building construction industry, Look at what's happened to the price of lumber over the last 2 years, what's happened to steel and other metals. Some of those prices are more felt directly than others, depending on your personal situation. But we'll keep talking in the aggregate and expand that window out one step. So expanding that window one step, and we look at a 3-year annualized number of inflation, and you see it's still a high level of inflation. That light green line is used cars. Again, they were my canary in the coal mine. They were the item that jumped first in terms of prices. It's that concept of substitution, that idea that people couldn't buy new cars, so they went and bought used cars. They didn't just buy used cars. Prices on used cars increased on an annualized rate at 42%. Enormous jump in the price of used cars. That told us that despite the Fed in the mid-2021 saying inflation is transitory, inflation is not transitory. If a large ticket purchase, a durable good purchase like an automobile, is seeing significant and persistent inflation, that says inflation is going to be around for a little while. And that's the scenario we saw in 2021. We turn the calendar to 2022, geopolitical influences contribute to a rise in energy prices, and we saw significant price appreciation in energy prices. But across the spectrum, and the last line there is services. Services makes up about a third of CPI. It makes up a little bit more than 40% of core services CPI. Shelter is two things. It's rent and owner's equivalent rent. Rent is straightforward. We all understand a rent payment. Owner's equivalent rent is, as a homeowner, translating what you currently pay for home costs into a rent figure. And I can tell you from having a 30-year fixed rate mortgage, as many of you are homeowners in the room probably have, that 30-year fixed rate mortgage does not change month to month. But the owner's equivalent rent for it does. It takes about 8 to 9 months for that number to work its way through the system. So we are still feeling impacts from the rising home prices we saw early last year and the year before. We're still feeling those today in the inflation prints. That's something that will dissipate over time from inflation, as we've seen home prices level off in some places or fall in other places in the country. But giving that Fed perspective, let's go all the way back to 2009. Let's look at the full cycle. And those full cycle numbers on an annualized basis are in the 2s. A couple of them are in the 3s. That says even with the last 18 months of price pressure, we are now just nose above water from an annualized perspective on the Fed's target. I'll call you back to that 3% inflation number that we all just sort of throw out as a colloquialism that, hey, inflation is about 3% a year. We didn't get there in most of those categories on an annualized basis on the 2009 to 2022 perspective. That doesn't make the change in family budgets or in business finances any more digestible. But it puts into context why the Fed was a little bit late to the party. Why at the end of 2021 they kept saying transitory. And those of us in the economist profession are banging our hands against our heads saying, why don't you see this? Well, they were looking at the long-term picture. And the long-term picture at that point in time had annualized rates of inflation of 1.7 or 1.8%. We weren't quite there to the 2% rate yet. It didn't look long-term economically damaging. We, of course, roll into 2020. Dynamics change and influences to push inflationary pressure rose, and the Fed acted swiftly. We'll talk about that in a moment, because the second question I get is usually around employment markets. And in a room full of business owners or folks working in the business world, you have felt this one more directly maybe than inflation. Because this, I think we've all felt. Employment markets have been challenged, to say the least, since the onset of the last recession, and really since the onset of the pandemic. We've seen it in the unemployment rate. Unemployment rate now sits at 3.5%. We have tried in 3 different instances to jump up to 3.7%. We've vacillated between 3.5 and 3.7 3 times now over the last 6 months. The Fed talks about full employment. And full employment is a concept that is not zero unemployment. Zero unemployment is not plausible. People will always be moving around the economy. They will always be moving around the country. They will always be changing professions. You will always have transitory, and I'm using that word correctly, by the way, transitory unemployment, so there will always be a number greater than 0. The Fed has argued over time whether that number is 6 or 5 or 4, and we've seen Greenspan and Yellen and Bernanke all come up with different definitions, but somewhere in that range, let's say, of 5 plus or minus 0.5% is full employment. At 3.5%, we are definitely below that number. Even if you take Yellen's 4%, we are below the level of full employment. That means that there is not enough supply in employment markets to go around. And we have certainly felt that. The question is why? And the first answer is labor force participation. We saw a large disruption to labor force participation in 2020. We saw something similar in 2008, 2009 for much different reasons. But we saw a number that used to be in the mid 63% range. So the mid 63% range of 330 million Americans are in the labor force. We went down to nearly 60% of Americans in the labor force. You might be thinking, oh, that's 3%. I mean, the esteemed gentleman who missed the Dow by 15% got that wrong by 5 times as much, and 3% doesn't seem so bad. But that 3% on 330 million Americans, just do the math with me, is millions of Americans not in the workforce, not even looking for a job. That's corrected. We've come back into the low 62% range, but we are still 1% to 1.5% short of where we were before the pandemic. I am going to argue with you that this is as good as it gets from a labor force participation based on the current composition of the country. Why? A couple things happened. In the late 2020, and we missed this because COVID dominated the headlines and the economic fall and recovery were dominating the headlines. We hit peak baby boom retirement in late 2020. The peak for the baby boom generation, largest generation in the American workforce, peaked in 2020. That bell curve, we are on the downside of that bell curve, but we are still at an elevated level of retirements. So as retirees come out of the workforce without individuals to replace them, labor force participation declines. We also saw a number of Americans that were approaching retirement age, and we've seen this phenomenon in a couple of successive recessions. We saw Americans approaching retirement age be disrupted from their employment during a recession, or in this case, during a pandemic-induced recession, make the decision, I'm not going to look for a job for a year. I've been separated from my employment. At the time, if you're talking about 2021, oh, my investment accounts have recovered. I feel pretty confident about my retirement balance. I'm going to walk away from employment. I'm not going to look for another job for a year or 2 years. That accounts for about 1 million Americans in our estimation that made the decision to retire early. So early retirees, peak baby boom retirement, and a change in work dynamics. There are a number of individual Americans who were 2-income families that now still are a 1-income family. Why? Because the delta, the change between being 2-income families and paying for childcare, elder care, and other associated transport or transit benefits, and the additional salary for some Americans is about that much. And when you're in the middle of it, and that extra few dollars a month makes a difference, you stick with it. When you've disengaged and realized that there is benefit to your time that is in excess of that much extra income at the end of the month, it's easier to walk away. And we've seen a number of Americans walk away from being a 2-income family. So that dynamic has changed. Why do I say that's as good as it's going to get? It's the bottom number. That's the core working age demographic. So it's 25 to 54. We're getting rid of those that can choose to be students. We're getting rid of those that can choose to be early retirees. And that core working age demographic is actually at a higher rate of labor force participation than they were on average before the pandemic. So we're about as good as it's going to get from labor force participation. What does this mean for job openings? This number peaked at nearly 12 million. It persisted above 11 million for quite some time, and we've seen successive months of decline here, such that we're in the 10 million range. 10 million still seems like a lot, because pre-pandemic, we were sitting somewhere around the 7 or 8 million range and hiring about 6 million a month. That's a pretty sustainable number for an economy. If you're looking at 11 million openings and still hiring about 6 million a month, we're at a rate where it is effectively 2 jobs for every 1 job seeker. That means in every employment decision, 1 company is shorthanded and 1 is not. Complicating factors, the quits rate's been north of 4 million Americans a month since September of 2021. That's a long time from an economic perspective to see a number of Americans leaving their jobs at such a high rate. But they're not leaving their jobs and leaving the workforce. Maybe that was the phenomenon at the very beginning of that time frame. But for most of 2022, and even the tail end of 2021, they were leaving and going to your competitors. And they were doing so because of an increase in wages. Job stayers, in a pre-pandemic sense, job stayers saw between 2.5% and 3.5% raises on average. Job switchers would see between 4.5% and 5%. So on an average basis, yes, it pays to be a job switcher, but it doesn't pay a lot more to be a job switcher. In the post-pandemic period, anyone want to hazard a guess what that dynamic looks like? No, really, 8%. 15, somebody got it. Put that on the economic forecast and give this guy 100 grand. 15. Job switchers are getting 15. Stayers were getting 5. It's a 3x difference to switch jobs instead of a 2% benefit. It's a huge difference. Incentive was there in 2022 to switch jobs. Why? Because you can't hire somebody unless you pay them. And that's the dynamic as business owners or as business managers that we've faced. Talked about the inflation on a prior cycle basis relative to wages. Wages outpace inflation. Simple concept, a really oversimplified economic concept. The increase in wages on average is going to be about inflation plus some measure of productivity. Think about it as a business. If you have an experienced employee and that employee produces more than a new hire produces, they're producing more economic benefit, be it revenue or income for you as a business owner. You are happy to pay them a little bit more of that increase in productivity in wages. So they outpace inflation. Dynamic since the pandemic, upside down. Inflation has outpaced wages. We saw this dynamic occur in the 1970s. It's wage push inflation. We are not seeing wage push inflation today. Why? We've seen a bit of a dynamic emerge where even though the average American worker now has seen a pay cut in real terms of 2%, that's that orange line. It was as bad as 3% 2 months ago. But the difference between inflation and wage growth means in real terms, the average American worker over the last 12 months had a 2% pay cut. And I've got about 16 heads that are tilted to the side of me saying, wait a minute, I just gave people 3 times the raise that they've seen in years past in the last year. Yep, you still fell short. And that's not a condemnation of the amount of raises. I applaud you for stepping up and keeping pace with inflation. That's the reality of how quickly inflation moved. So fast that American businesses couldn't keep up with it. Because you puts you in a situation where if employee A comes to you and asks, please give me a raise, it's hard to make ends meet because of inflation. You've got 10 other people in that same job. You need to go around and give those 10 other people, because you know he's going to go back around the water cooler and say, hey, Bob gave me a 10% raise. I said I had trouble making ends meet, and all 10 of them parade through your office. It's a macro decision for you. Here's the reason. We're going to link employment, wages, and inflation. And the Fed looks at typically a relationship between the unemployment rate and wage growth as almost perfect inverse relationship. And that existed before the pandemic-induced recession. You can see those changes in those lines that represent the unemployment rate and represent the increase in wages or average hourly earnings. When unemployment moves down, wages move up. When unemployment moves up, wages move down. Simple concept, right? Less people to hire, you got to pay more. More people to hire, you can pay less. That existed for a couple months after the end of the pandemic as the employment markets righted themselves and then became entirely disjointed. That Phillips curve relationship that the Fed constantly goes back to in terms of a bedrock understanding of making policy decisions has in fact broken down. And now wages seem more beholden to changes in inflation than anything. And encouragingly, it's not wages forcing inflationary change. It's inflation forcing wage change. And that's why I say we're not in a wage push inflation scenario, because inflation is leading wages. Now, that occurred at the beginning of the 1970s, and in the mid-1970s, that dynamic shifted, but you didn't have a Fed that was nearly as active as our Fed has been in the early 1970s. Maybe that's one thing I'll give them credit for. Inflation expectations are another area of sticky pressure, though. We talked about wages. I think we put wages aside for right now, that wages aren't driving inflation any higher. Wages, in effect, are coming down as inflation comes down. Another area of inflation being sticky and driving higher is what we call inflation expectations. And inflation expectations, you might be thinking, wait a minute, how can somebody's expectation for inflation actually push inflation higher? Straightforward concept. If I'm a consumer and I'm sitting in the early part of 2021, I want to buy a couch. And my wife says, we need a couch, and you better go out and buy the couch. And I go to the store to buy the couch, and they say it's 54 weeks to get the fabric you want. Actually, to get any couch, it's 46 weeks. You think, oh, geez, I'm not going to have a couch for a year. At first, individuals accepted that, accepted those supply chain difficulties, handed over their money, and waited a year to receive their good. Durable good orders were up. Then all of a sudden, we saw a point of capitulation. The average American consumer said, I'm not waiting a year. I'm going to wait till the good's available. I'm not going to hand over my hard-earned money. I'm going to wait. And they waited. But then you hit 2022, and all these headlines about inflation going up, all these headlines about price pressure. You go back to the store and you say, how much is the couch? Oh, it's not that much more than it was before. When can I get the couch? Oh, 13 weeks? Placing the order. So your expectation there in that scenario is that the price is going to go up more because of all these headlines you see in inflation. Your expectation that inflation goes higher actually forces you or encourages you to spend money now. And if you spend money now, you're actually self-fulfilling that prophecy of higher inflation in the future. And we saw that play out. And as you can see, it almost looks like a mountain range in terms of those top two numbers. And those are the University of Michigan and the Conference Board's 1 year ahead surveys of inflation for American consumers. We have seen those both come down significantly, now down under 5% for 1 year ahead. So the American consumer is now on a multi-month continuous basis anticipating inflation will continue to come down. That's reinforced by the 3 and 5 year ahead numbers, those orange and green lines that show that inflation over the 3 and 5 year period, the average American consumer is expecting to be somewhere in the mid-2s. The bond market agrees. Smart money in the investing world's in the bond market. It's not the equity guys touting XYZ stuff. The bond guys, they can do the math in their heads better than you and I can. That baked in inflation expectation in the 5 year tips is the pink line. And the 5 year Treasury inflation protected securities tells us that inflation over the next 5 years will average somewhere just north of 2%. So with all of those converging towards 2% over the long run, it seems that inflation is a problem that is on a path to a solution. The consumer can upend that if consumers keep spending. But as we've seen with both retail sales and with personal spending, the consumer has slowed their rate of spending. Curiously, though, as we look at the personal spending versus income, at the beginning of 2022, those lines crossed. People started spending more money than they were making. Now, where does that come from? That comes from, one, the savings rate. You can see that huge ballooning in the savings rate on the blue line. Those are the first stimulus from the Trump administration and the first stimulus from the Biden administration. Those two large fiscal stimuluses, Americans largely put in the bank. I can tell you from the banking perspective, this is a survey number that comes out quarterly. Even though that's saying 25% was the peak, we think the peak was somewhere in the mid-30s in 2020 in terms of deposit balances. If we look at that money being put in the bank, all of a sudden American consumers start spending. At some point that inflection happens and their pace of spending has now outpaced their income. And we see that reflected in the orange line. And the orange line, the change is consumer credit. And this is not, my disclaimer, this is not a 2006 to 2007 type consumer credit scenario where we're writing bad loans and giving strawberry farmers $1 million loans on homes. What we're doing here is we're seeing a normal uptick in usage of consumer credit. And this is a normal occurrence we see in advanced recessions. We normally see consumers make more use of credit because they don't have the income to support their spending rate. And we are definitely seeing that today on a persistent basis over the last 6 months. Consumer sentiment at the same time has sort of bottomed at a very low level. Those numbers that you see up there actually in July of last year are the lowest going back to the advent of the University of Michigan survey. So that includes the early 1980s, the outcome of the 1970s triple dip recession with lower level of consumer sentiment than we were at that point. And that level of consumer sentiment being so low and kind of meandering around in this low level says consumers are not as confident about either the current economic state or future economic direction. That does not create a big motivation to resume spending. That creates a motivation for consumers, typically when we see this basing pattern in sentiment, to pull back, to start to save a little bit more. And you saw in the savings rate, they haven't done that yet. But we anticipate that to start to occur as economic conditions continue to slow in 2023. So if the consumer slows, and we're a consumer-driven economy, it's reasonable to assume that we would see an economic slowdown. Another reason to assume an economic slowdown, this significant increase in monetary policy. I have to go back, and the Fed has now raised 50 basis points in the last meeting. They are, from a probability perspective, we'll see what they're going to do at the February meeting in a moment. But that 50 basis points is on the heels of 4 successive 75 basis point increases. To go find one 75 basis point increase, I have to go back to the early 1990s. Just one. To find 4 in a row, I have to start getting out my crayon and making things up. The amount of monetary policy change we've experienced in the last 12 months is extremely high. I can't discount that in any way. The Fed is clearly articulating that they've learned a lesson from the 1970s, and they are trying to combat high inflation with the biggest hammer they can find. We used to, before 2022, we used to think a 50 basis point increase was, oh my gosh, the markets would have a huge reaction. The markets don't care about 50 basis points anymore. At 75 is the big hammer now. And we have seen the Fed use that to raise rates from effectively 0 at the start of last year to now between 4.25% and 4.5%. That's a lot of change in terms of rates. We saw it in mortgage rates, and we will see them continue to do so. The important thing for me in Fed policy announcements is not what they did in terms of the basis point increase or decrease, it's what they said. And what the Fed has said, both coming out of the December meeting and since, is that they continue to be resolutely determined to fight inflation. That they see it as a persistent long-run problem in the economy, and they are going to continue to act in an aggressive manner to contain inflation and not allow it to flare back up. Think about it like fighting a forest fire. They don't want a new spark to engulf another couple hundred acres. So probabilities right now, nearly 80%, the Fed again hikes in its February 1st meeting. With the Fed's long-term projections, they're estimating another 50 basis points of increase in the federal funds rate to get them to a top-line band of 5%, and then possibly a pause to wait and see. Pause to wait and see. Fed policy takes about 6 to 9 months to work its way into the economy. We are just at the front end of those 75 basis point hikes. There is more economic result to be seen from those Fed hikes that occurred last year. From a probability perspective, we look at the futures market to give us that probability, and what we're looking at is that we see a step up of 25 basis points at the February 1st meeting, another 25 basis points in the March meeting. There's that pause. And the futures market is actually telling us by the end of next year the Fed is cutting rates. What type of environment would make the Fed pivot from raising rates to cutting rates in the same 12-month period? Quick answer, recession. You're going from putting the brakes on the economy to stimulating the economy in a 10-month pivot. Something has to have happened. Now, many of us that watch the Fed pretty closely think that is a pretty extreme policy pivot. Even though the futures market is pricing that in at probabilities, you can see what the probabilities are in those out months. And they're not as high as they are, obviously, in the nearer term months. For the Fed to do that, we have to actually have gone through a more restrictive recession than I think we're projecting. I don't think the yield curve necessarily has all of that fully priced in. And we've definitely seen the yield curve invert. Inverted yield curve is a very oft-quoted predictor of recession. The 2-10 part of the curve, the 2-year to 10-year inverted, has been inverted since last summer. Persistently inverted, a persistently inverted yield curve, and the 2-10 portion of the curve says that there is a 65 to 68% chance of recession in 6 to 12 months. That puts recession sometime in the first half of this year. The 3-month to 10-year part of the curve inverted persistently in October. That one, combined with the 2-10 inversion, takes our probability of recession just solely on yield curve measures to north of 78%, and that takes that window again 6 to 12 months. So 6 to 12 months from October means sometime in the first 3 quarters of this year if you want to take that extra 20% of probability. Mortgage rates have obviously reacted to this Fed policy. We have seen rates peak at 7%. They've come back in significantly. What has that done? Of course, decreased housing activity, where we saw housing activity very constrained because of supply issues. Now we see housing activity constrained because of demand issues. If you could get a mortgage at 2 7/8 and now your mortgage is 7%, that is a huge change. If you've refinanced at 2 7/8, your cost of switching into a new home, a bigger home, has now materially changed. That decision is harder to make. So now that turnover in the housing market, whether it be from new home creation or existing home sales, is slowing and will continue to slow as rates remain high. The last thing we'll look at in terms of a stage setting before I give you my outlook is ISM Purchasing Managers Indices. Both of them has tipped over the line below 50. Both the services and manufacturing sides of the economy are in contraction. Word choice is important here. Contraction is not recession. Contraction means things are slowing as opposed to expanding. If we look at the manufacturing detail, just about every segment of the manufacturing PMI, just about every segment in the manufacturing world points to contraction. Whether it be new orders or backlogs or prices paid or employment, everything is contracting in manufacturing. That tip over to everything contraction happening 2 months ago. If we look at the services side, it's a bit more of a mixed bag. There are a few things that are holding their nose above water. There are a few things that have slipped down below the water. But it's the thing that slipped below the water that are concerning for me. It's new orders. It's new business activity. Backlogs are still robust on the services side of the economy. They're still playing catch up to an extent with some orders. Talking to a few service-based businesses, they're seeing their backlog lasting them through June, May, July. Beyond that, they're counting on new orders, but they're not seeing the new order flow this year that they saw early last year. So services is starting to show signs of slowing down. What does all this mean for the view forward? And this is the point to look forward for us. So a quick, and I realize I'm a couple minutes over, but we will plow on. So my recession probabilities. This recession model is from Capital Economics. It's a highly accurate recession model, particularly the 6 month ahead. Since the 1960s, it's only missed once when it's been north of 50%. And that was in the 1960s. The 6 month ahead recession model is at 91%. That we tip into recession. The 3 month ahead model, less predictive accuracy in the 3 month ahead model, but the 3 month ahead model as of the end of November, these numbers are as of the end of November, as the end of November was about 32%. So I take that 3 months ahead, that takes us into the first quarter of this year. I combine those two, and that's supportive of my own work that we are not in recession at the end of 2022. We likely do not tip into recession, barring some major change in economic activity in the early part of 2023. The more likely arena is the early part of the second quarter. And I know consensus right now has that in June or July. I'm putting it in April or May. Just because I think there is more impact from the Fed and their aggressive monetary policy changes that we have not felt yet. And we will see those in economic numbers in February and March and in April. Now, does that get called in the spring? No. In either case, whether it's July or it's April, the NBER is usually about 6 months late. So they would be in October saying, oh, by the way, at the beginning of April, we entered a recession. By the time they get around to making that call, my forecast is that we're on our way out. We're actually moving out. Short, shallow recession is the base case scenario that we are moving forward with for 2023. That short, shallow recession has a couple slides here that will give you the impact and what it looks like. But that scenario would be in the fourth quarter we start to emerge and we see positive growth in the American economy in the fourth quarter of this year. What does that look like? It's based on a few things. Number one, I think inflation is going to decline faster than the Fed estimates. The decline in inflation likely gets back to a number that is more in line with historical averages by the end of this year or the very beginning of 2024. The Fed thinks we're going to be at elevated levels of inflation well into 2024. I just don't see that because of a couple key items. One, that shelter component starts to really dissipate and becomes a headwind to inflation going higher as opposed to a tailwind pushing it in about April of this year. Somewhere between the end of March and beginning of May, but let's call it April. At the same time, we have seen some significant moves in the headline rate of inflation, but barring any major geopolitical change, particularly in the crisis in Ukraine, the push in food prices likely has been seen to its extent in 2022 and dissipates in terms of the year-over-year roll, 12-month roll in food price inflation as we move forward through this year. And finally, goods-based inflation in a recessionary environment, we usually see some deflationary, not disinflation, which would be less than, but below zero deflationary impact in goods inflation. Now, that's only about 30% of the equation. Services is 70%, but if we've got shelter dissipating and we've got goods pulling back, now you're making up some 65% of the inflationary picture. And even if we have persistent pressure in other areas of the services economy, inflation likely falls faster. Employment, I would project this to be what, and I'll borrow a term from another economist, a job-full recession. Based on current demand for labor, based on businesses willing to step into the gap in each of the last 6 months when unemployment starts to tick up, businesses stepping up their hiring rates, we are likely to see some pullback in employment markets, but not to the extent we saw in, say, an 08, 09 type scenario when we got up to high single digits. We're thinking that a number plus or minus 6%, I would shade to the downside of that number, looks like a reasonable level of unemployment to reach by the mid to late part of this year. With a recovery starting towards the end of the year and moving into 2024 and pushing that rate back down into the 4% range. With that as a backdrop, with employment remaining robust and inflation pulling back, that means wage pressure also dissipates in that type of environment. Less demand by individuals that are hitting the unemployment lines for higher wages, they just want a job. Inflation also coming out of that equation, and inflation has been pushing wages, not the other way around most recently. From a GDP perspective, that looks like a slight pullback in GDP in the middle quarters of this year. An overall pullback in GDP less than 2% in terms of an annual basis. This is not a 2008-2009 scenario. This is definitely not a 2020 type scenario. This looks a little bit more like the early 90s recession from a forecasting perspective. Your average recession on a cyclical basis, 3 different types of recession: event-driven, which we saw in 2020, structural, think about bubbles bursting, 0809 is a great example, or the internet bubble in the early part of the 2000s, cyclical, which we really haven't seen since the early 1990s. Typical cyclical recession lasts on average 8 months and has about a 2% pullback in GDP. And that's about the scenario we're painting here in terms of forecast. My outlook across the board with my fun-colored arrows. We're going to look at inflation coming down, unemployment going up. The rate on the 10-year Treasury, the yield on the 10-year Treasury, I had going down. It's probably going to be a pretty marginal decrease from here. I think we're almost just kind of an equilibrium rate for the short term in the 10-year, so I added that purple, I don't know, maybe sideways. Fed funds rate, I would project we will go higher. I don't see the Fed cutting rates this year. I think we hit 5 and stay there for a period of time. GDP growth obviously down from where we've been the last couple of years. The only red arrow that points up is recession. Recession probability obviously increases in this type of scenario. My one real cheat is stock market returns, sideways, down, and up. I picked all of them. The base case here, and the one below it explains it, and that's why I added volatility. Volatility will be higher. This is going to be a year in which we will see higher levels of stock market volatility. Frankly, we will see higher levels of bond market volatility. That volatility will stretch across the globe. There's not really an asset class to necessarily hide in, even cash, because you will miss the eventual recovery. Fun fact, the 10 best days in a bull market contribute disproportionately to your return. Do you know when those 10 best days occur? Exactly. Almost immediately after the 10 worst, within 2 weeks of the 10 worst is when you have your 10 best. If you parked your money in cash and you waited till you think things are better, you missed the best of the market. Missing the best of the market can be, if we're talking about a growth of $10,000, can cost you $1,000 of that $10,000. It costs you 10% of your return. So we are not advocates of sitting on the sidelines. We are advocates of using the final item, the value of diversification. A diversified portfolio weathers the storm. In a cyclical recession, there are areas that outperform, there are areas that underperform. This is not a scenario where correlations all go to 1 and everything falls off a cliff. This is not a scenario like we saw last year, a 200-year one-off instance in the bond market where bonds fall and at the same time stocks fall. This is a year in which diversification actually matters. To having safe ballast in the portfolio combined with risk-taking assets to construct a good balanced portfolio, not really the full let's go forward 60-40 portfolio. I'm talking true global diversification, using high yield, using emerging market debt, using real assets. For us, we like real asset categories like commodities, infrastructure, going forward as nice, safe places to help with return and produce some cash return on the way. I know we saved a few minutes for questions. I'd be happy to take those at this point. If you all take a second and read the disclosures. My compliance officer will thank you. And you were all speed readers, so I appreciate that. Thank you.
So you talked about volatility and anticipated inflation, consumer sentiment. So my question is our outlook of the economy as a consumer, is it economic or political? Are the consumers smarter about the economy than they were before? Do consumers really care? And do they actually participate in the success of the economy?
Wow. Lots of questions. So, consumer versus politics. Politics is an outside actor. Consumers are an inside actor in our economic system. Yeah, it's opposite for China. China, right? The politics is the inside actor, the consumer is the outside influence. For us, it is the direction of the consumer. And for most consumers, it is an individual decision. I pointed to that with the description of inflation. We've all felt inflation differently. We will continue to feel economic benefit differently. We can already point to some examples. Layoffs in the tech sector are significantly higher now than they've been at any point in the last 15 years. Those folks are not finding new jobs in the tech sector. The 2 areas of the economy that have actually seen the most robust job growth are healthcare and financial services. But they're hiring technology. They're hiring from the technology ranks into those 2 other sectors. So again, an idea of winners and losers. Consumers would find their own individual path through. And is the American consumer smarter? I think there's wisdom in crowds. Great book if you want to read Wisdom in Crowds. But there is some wisdom in crowds. But at the individual level, we are beset by plenty of behavioral biases that make us imperfect actors in the economic system. I got a whole other thing on efficient market hypothesis we can talk about some other time.
I'd like to thank you for your presentation today and appreciate your outlook on the U.S. economy. I'd like to know how you think we're going to fare compared to some of the larger global economic influences that we're running into.
Thank you for the question. Always good to be pulled back to the global perspective. From a global perspective, this does look like a global recession for 2023. Most every country is going to be impacted by this in one way, shape, or form. Europe and the UK likely feel it worse than we do here in the United States. I would argue that the UK is probably already in recession because their inflationary problem is worse, and they had a pretty decent policy misstep, trip, and governmental problem as they rolled into the end of the year. Europe is likely on an unavoidable path to a more restrictive recession than we're going to experience here, just because they feel more resolutely the inflationary pressures and have a closer proximity to some of the issues that Russia creates that are non-factors here for us in the United States. Those countries that would escape it would be potentially those countries that have more of a resource reliance, particularly on the Chinese economy. If China decides to stimulate its economy through further infrastructure growth, countries like Australia could find an escape velocity, as they did in 08 and 09, from a cyclical recession, or experience a much shorter one than we do here in the United States. Those others that are a little bit more beholden to bad balance sheets and commodities would ebb and flow with the commodities a lot more than they have over the last several years. So that's Southeast Asia and South America. So the base case here is, and I didn't mention Japan, I guess. Japan actually is running about 4% inflation right now. That's an enormous amount of inflation for Japan, actually, that had been deflating for about 20 years. They would be really comfortable with 2. The problem with Japan is they own about 60% of their JGBs are owned by the Japanese government. So they are heavy actors in the debt markets right now on their own, and may be able to skate their own path through to much shallower, or maybe escape recession if there is one global economy that dodges it.
Thank you. Thank you so much for your insight today. Saw last week that the FTC is proposing a ban on current and any past non-competes. So for many of us that are in the professional services arena here, probably may impact many of us. Just thoughts on where this might be going. There's a listening period that's occurring right now. I believe public comments are being shared with the FTC. Is this a material enough piece of the economy from an employment perspective that it would really shift anything or matter?
It's tough to say because we're in that pre-comment period. As we've seen with a lot of legislation and a lot of regulatory change, particularly in the financial service industry, to be honest, a number of things can change materially on the other side of a comment period. They can realize that there is a drumbeat of opposition. They can realize that there is an outsized impact that they didn't see. From an economic impact, broadly across the economy, it helps on the margin, but it doesn't change the employment picture to a great degree. There just aren't enough individuals that would be hampered by non-competes that would be then immediately freed and extra labor supply released, because they're already counted in the labor force number. They just can't work in certain geographies or certain industries. Thank you, everyone.